All right, let's talk about bond valuation today. We're going to cover some topics that are in chapter 5 of your book. And the chapter has actually a lot of different terminology, new terminology if you're not familiar with bonds. So we're not going to talk about every term that's introduced in the chapter, but we will focus on the valuation concepts that need some explaining to. It is important, I'm going to keep reminding you, but it's important that you should read the chapters from the textbook. So let's get started. So Mr. De Niro loves the zeros and he decides to invest in 5-year treasury strips with the par of 1,000, which are currently priced at 620.92. What's the yield to maturity on the De Niro's zeros? Well, thing about bonds is that they have a certain time frame, and then they mature, right? For instance, this is like a 5-year bond, right? A typical plain vanilla kind of bond may be issued for 5 or 10 or 20 or even 30 years. And what the company is doing while it issuing bonds and selling bonds to you is that it's borrowing money, right? So if it's $1,000 bond and sold at par, uh, which would be $1,000, if it's sold at par, then the company borrows $1,000 and then it pays you back some interest, typically called coupon interest payment. Some annual interest payment, typically it's paid out twice a year, so it's actually semi-annual coupon payments. And then at the end, you get the $1,000 back. But this is a different kind of bond. Here, there's no annual interest payments at all. And so it's called a zero, which means that we're talking about a zero coupon bond. All you get by investing in this bond is $1,000 back after 5 years, right? So how much are you gonna pay or invest in this bond? It can't be $1,000, because if all you get is 1,000 5 years later and you pay 1,000 for it now, then that means that you're earning 0% interest on this loan. And you're actually losing money, given that there's going to be some positive inflation, right? Or the dollar losing value over time due to prices generally rising. So if there is any inflation, you'll lose money if you paid 1,000 for it. But you're not, of course. We're being told that you're only going to pay 620.92, right? The price of the bond is 620.92. So the question is, what is the annual return on this bond? If you buy it and hold it to maturity, what is its yield to maturity, right? So the treasury strip, a strip also has a very interesting history. It stands for separated treasury receipts for interest and principal securities. So it's actually an acronym. But what happened is that the Treasury had observed that other banks were actually buying up a bunch of long-term Treasury securities, and based on the annual coupon from those long-term securities, they were making zero coupon bonds and floating it to the public. So all the coupons that the bank would collect from its investment in treasuries during the first year will become basically the source of income to repay a 1-year bond that the bank was floating, right? All the coupons from in year 2 of a long-term bond would become the source for principal repayments on 2-year bonds that the bank was floating. So the bank was actually investing in a lot of long-term coupon-paying bonds from the Treasury and using the coupons as a source of repayment on zero coupon bonds that it was issuing. So the Treasury decided, well, they could do it themselves, right? And they started calling those strips, as I said, the acronym, it's an acronym, it stands for Separate Treasury Receipts of Interest and Principal Securities. Anyways, you don't need to know all that. It's just a colorful history. Just know that a strip is a zero coupon bond, right? Which would be any bonds that the Treasury issues for less than a year in maturity. Those are called Treasury bills. So there'll be 3 months, 6 months, 9 months, or 1 year T-bills that are issued. They will not have any interest payments, right? But Treasury bonds and bonds longer than 1 year will carry some coupon typically, except for these strips. So we have a 5-year. We've got a 5-year issue that does not pay annual interest payments. All it pays is the $1,000, the par value at the end, right? So what is your annual return? Well, we know how to do this from our chapter on time value of money. What we have is a present value, which is $620.92, a future value, which is 1,000. We have n, which is 5, and all we need to do is find the interest, right? So basically, the present value equals future value divided by 1 plus I raised to the power of n, and the n is 5. And we can solve for I by taking both sides to the power, well, dividing both sides by 620.92, then taking both sides to the power of 1/5, and then subtracting a 1, and we'll get 10%. Of course, we can use our calculator. You could use your calculator, and this is how you could easily get this answer using the calculator. So if you're going to the calculator, I would go, let's see, so second FV to clear everything. You put 1,000 as future value, then 620.92, make it negative, right? Because you're going to spend that money. That's present value. 5 is n, and then compute I. And you get 10.0004. I mean, it's very close to 10%, right? That's it, the answer, which is 10%. So that's the annual yield on this bond. If you bought this bond and you held on to it till maturity, you're definitely getting back 1,000, and you are sure of making 10% per year on this investment. Okay, so now let's go to a regular plain vanilla type of coupon paying bond, right? So here's a bond, Get Me Out of Here Incorporated issued a 20-year bond 5 years ago. The bond carries a coupon of 8%. It's currently priced to yield 10%. What is the current price of this bond? And what is the current yield, right? So we're going to be looking at a couple of things. First, we'll calculate the price. The yield, 10%, is the yield to maturity. Current yield is something different. It's what you get during this current year based on your investment. Now, this bond was issued 5 years ago, and back then 8% would have been just sufficient enough that the bond may have been sold for par, right? And we are going to assume, if we are not given any other direction, if we're not told that the par value is something other than $1,000, we will always assume that the par value of a bond is $1,000. Likewise, if we are not told that this coupon interest of 8% is paid at a frequency any different than twice a year or every 6 months, then we will assume that it is twice a year. So if it is quarterly, it should be stated explicitly. If it is annual, it should be stated explicitly, right? So we will assume, because we don't have any other statements expressing the frequency of payment, we will assume that this 8% coupon is actually paid out in 2 installments. So basically, that all interest rates we saw last time, that the quoted rates are all nominal, which means this 8%, if it is paid out twice a year, will be 4% every 6 months. Right? So it's not 8% is not effective rate, it is the nominal rate, and that's how interest rates are quoted in the marketplace. Okay, so and here's the second part to this question. It says, get me out of here bonds are also callable after 10 years of issue at a premium of par plus 1 year's interest, right? So what does this mean? It means that this bond has a call feature, and a call feature is a feature that that the issuing company retains and says that, it was at the time of issue, it's a 20-year bond. It says after 10 years, we may decide to call back the bond, which means we'll pay out the principal, and then it'll be over. We don't have to pay interest anymore. And that's not a good thing for investors, right? So companies may sweeten the pot by saying that, hey, at the time of call, we're not just going to give you the $1,000, which is the par value, but something extra. And what is that extra? It says it's callable at a premium of par plus 1 year's interest, right? 1 year's interest is 8% of par, which is 8% of 1,000 would be $80, right? So you won't just get 1,000 at the time of call, if the bond gets called, but you'll get 1,080, right? 1,000 plus 8%. So, and then if there's no such sweetener, then the bond, investors will lose interest in the bond, and they may only buy it if the price is lowered even more. So if we take that, if we assume that the bond gets called after 10 years, by the way, 10 years from issue, right? That bond was issued 5 years ago, so it's really 5 years from now. Likewise, when we are looking at the bond, it only has 15 years to go. So when we're calculating its price, it'll be based on 15 years of coupon payments. Anyways, so if we assume that the bond gets called and then we calculate the bond's yield, that becomes bond's yield to call. So we're assuming that the bond will get called the moment it becomes callable, which is 5 years from now. And then what is the yield to the investor? That becomes the bond's yield to call. Typically, companies would call back their bonds when interest rates fall, right? So this company is paying a coupon of 8% on this bond. Now, if interest rates fall, then it can it sees the opportunity of refinancing this loan, so to say, at something less than 8%. And if the bond has a call feature, the company will call it back and then issue new bonds at lower rates. Okay, so let's start to analyze this bond. The par value of the bond is not explicitly stated, right? So we should assume by default that the par value is $1,000. Also, the default frequency of a coupon payment will be twice a year. right? Because nothing else is told, so we will assume that. So here we have a bond that'll pay $1,000, which is the par value of the bond, in 15 years, right? It was issued 20 years ago. I'm sorry, it was issued 5 years ago. At the time of issue, it was a 20-year bond. So now it's only a 15-year bond, right? Um, Also, the interest payments in the bond, well, the stated coupon rate is 8%, but that comes in 2 installments. So interest payment is going to be half of 8%. 8% of what? Of the $1,000 par. So 8% of 1,000 is 80, half of that 40. So it's going to be $40 every 6 months. And remember, the bond's got 15 years remaining, and that makes it 15 times 2, or 36-month periods, right? So there's going to be 36-month periods. The bond's price is simply its present value at the investor's required yield. So the bond's yield to maturity is stated to us, and that was 10%, but that's also annual, 10% annual, right? Half of that is 5%. So the interest rate we will use to calculate the bond's price, again, it's a present value, is going to be 5%. Okay, so now we are ready to find the price of bond, right? It's composed of two things. That there's those $40 interest payments, which we call coupon payments, right? Another colorful history for that. In the old days, you used to have bonds that came printed on paper with perforated coupons, and you basically every 6 months, when the time came, you tear off that coupon, write your name and address in it, and send it to the company, and the company would know where to send the money to, the check for the coupon payment. And it would be that way they became bearer bonds, which meant that you could sell the bond to someone else, and that someone else could then use those coupons, write their own name and address in it to get the coupon payments after they had purchased the bond, right? But nowadays, of course, we have electronic records. The company knows who to send it to. Actually, the broker facilitates all of that. Your broker will have electronic records of bonds you own, and you will get the coupon payments on those bonds, those interest payments. But we still use the term coupon payments. But those coupon payments, like $40 every 6 months for 36-month periods, well, if you think about it, it is an annuity. And we know how to calculate the present value of annuity. The interest rate is 5% every 6 months. There's 36-month periods, and the payment is $40, and so we know how to calculate that present value. And then finally, after 36-month periods, we get, at the end, we get the $1,000 back, which is the par value. It's just one single payment, but we also know how to calculate its present value. So when we add both of those present values together, we get the bond's price. And so that's what you're seeing here. We have a formula for present value of an annuity, right? And we can crunch that out, multiply it with the payment, and we get the present value of the coupon payments. That's the first part. And the second part is the present value of this par value of $1,000 that we get after 6 months. I'm sorry, after 30 periods, or 36-month periods. So what is that $1,000 worth today? That's the present value. And we add up the two present values, and we get 846.27. Of course, as you know, it's a lot easier to do using our calculator. If we do second FV, and let the first part, I'm going to do the first part first, which is $40 is a payment, 30 is N, 5 is I by Y, and then compute PV, and we get 614.89. So that's the first, then we'll add the second part. So let me save that. Store STO1 saves this number. Oh, let's make it positive and then store it. STO1. So I use plus minus to make it positive, and then STO1 to store it as a positive number. Okay, then second FV to clear it. We do 1,000 as the future value. 5 is I by Y. 30 is N. And then compute present value. And this, the present value of this $1,000, 15 years from now, or 30 semi-annual periods now, is 231.38377. But let me make it positive, and then store in the second cell's STO2. Actually, it's already on the screen. All I need to do is take this second number and add to it the first answer. So plus recall 1 gives me 846.275. Right. So that's basically 846.27, which is our answer. Okay, I did this in two parts to emphasize that we are actually talking about present value of annuity and a present value of a single cash flow, and we're adding them up. Actually, your calculator can do the whole thing all at once if we just put in 1,000 as future value, 40 as payment, 30 as N, 5 as I by Y, and then say compute PV, we would get the answer, right? So the calculator is able to allow us to put both components, the payment and the par value, as a future value at the end. And then we can get the answer all in one step. So you can start to see how easy life becomes with this calculator. And it'll be even more evident soon, right? Okay, so next is the current yield and the yield to call. So what is the current yield? Current yield is defined simply as the annual coupon payment divided by the bond's price or value right now. And we calculated the bond's price at 846.27. Annual coupon payments on this bond is $80. So if you divided 846.27, you get 9.45%, right? So that is basically the income component of this bond for this current year, 9.45% on your investment of 846.27. If you buy the bond today, then this year on your investment, you're going to get 9.45% income, right? So that's the current yield. And that was different from yield to maturity, which we know is 10%. And what that means is that if you buy a bond for 846.27 and you wait for 15 years and then get the par value back, and in the meantime you're getting all the coupon payments, then your total return will be 10% per year. And it is higher than the current yield. Why? Because you're paying less than 1,000 for it. So you don't just have this income component of $80 per year, but you will also have capital gains of 1,000 minus 846.27 years. And of course, that capital gains accrues over 15-year life. So and that makes up for the difference between the 10% yield to maturity and 9.45% current yield, right? All right, now the second part of the question was that the bond is callable after 5 years, right? Um, then what is it yield to call? Well, it's callable after 5 years. They said the premium that we get is the par plus 1 year's interest. So the after 5 years, we don't just get 1,000, but we get 1,080, right? So now we know that the payments are 40. We know that the bond currently sells for 846.27. We know that there are 5 years to go, so there are going to be 10 semi-annual payment, right? And we know that the bond matures in 10 semi-annual periods, and we get 1,080. So what rate of interest are we getting on a semi-annual basis? That's why the formula says YTC by 2, because whatever we compute is going to be the semi-annual rate, right? And the formula looks really daunting, and the calculation by hand is not so simple either, right? Because the only way to get this answer is to put in a guess for whatever should be YTC by 2. We put in a guess, say I decide that I'll start with 3%. I put in 3% as a guess, and then I found out that the answer happens to be more than 846.27, right? The right-hand side computes to more than this 846.27. Then I will know that my initial guess was actually too low. Then my next guess would be a higher number. And if I get a value which is less than 846.27, then I know that the actual answer is in between my first two guesses. And then I'll guess another number in between. And that way, over several iterations, I get to close in on the right answer, right? And that can take a long time by hand. So it would be, we're finding a missing rate, which would be a cumbersome trial and error process if we did not have our fancy schmancy handy dandy financial calculator, right? And that calculator can handle this. So what we need to do is remembering that this 846.27 is our present value. Let me put that 846.27. Second, if I forgot to clear it. All right, 846.27 negative. If I buy this, and it'll be a cash outflow as the present value, and 40 are the payments, and 1,080, 10,1080 is the FV, and then what else do we know? 10 is N. I want the calculator to compute I by Y. And then when I click this, I get the answer of 6.75%, right? And so it came. If you're holding a handheld calculator, it may take a moment to get you this answer because it's going through the same trial and error process that I described before closing in on the answer. In the computer simulator, the answer came immediately. But our answer is 6.75%, right? Now you got to remember that's YTC by 2. That's the semi-annual rate. So the annual yield to call, the nominal rate, is 6.75 times 2, or 13.5%, right? And that is our yield to call for okay, so this is what we did. We got 6.75% semi, and we'll multiply this with 2. We get 13.5%, and that is the yield to call, right? Okay, here's another problem. Gotcha Company has just issued 10-year debentures which carry a coupon of 7% and sell for par. An unexpected commitment of Gotcha's CEO to an asylum makes the company's VP of marketing, who is a non-UT Tyler graduate, the prime candidate to take over the reins of Gotcha Company. Okay. So the CEO goes to asylum, then we got VP of marketing. It's not a UT Tyler graduate that's going to take over the CEO's responsibilities. And that cannot be good news to the marketplace, right? Due to the expected decline in the quality of Gotcha's management, analysts lower its bond ratings, resulting in an increase in its required yield to 8%, right? So basically, it's not someone who's not a UT Tyler graduate is going to take over, and of course, the markets respond appropriately by saying that the risk inherent in this bond and the company's bonds have now gone up. And you may find in your book, you'll find a table of ratings, bond ratings, right? Bond ratings. We'll see one in just a second in the next problem or so. But the bond ratings, there are different companies that rate different companies' bonds. There's S&P and Moody's and Fitch's. Those are the most common ones. And S&P ratings go as AAA, which is the best rating. Then the AA is next best, and A is third best. And Moody's also uses AAA, AA, A, but they use a capital A and two small a letters. Just a different way of distinguishing their ratings. And then there's triple B, and for Moody's it's BA, and so on. So, and the best ratings are for companies that are considered to have the strongest fundamentals. And financially they're the strongest, and that means you don't risk any money by investing in those companies' bonds, right? So a 10-year bond, for instance, the company must be around for 10 years to pay you interest for 10 years and then repay the principal, right? So how likely is it that the company may default? Gives those ratings. And these different companies have built a reputation over time, like the Standard & Poor's ratings are well-renowned. Moody's ratings are well-renowned because they have built a reputation of being independent and fair. All right. So if a rating is lowered, that means the risk assessment is higher. And then investors will require the company to pay a higher yield, right? There's a lot of things in here to take note of. First, it's a 10-year bond, it has a coupon of 7%, and it sells for par, which means it sells for $1,000. You pay $1,000 for it, and in the end, you'll get back $1,000. So what do you get on this bond in interest? Just the 7% coupon every year. There's no capital gains. So the yield to maturity on the bond initially is 7%, right? But now, with this change, the yield is 8%, and we will see that the bond's price is not $1,000. It's going to be less than $1,000 because the required yield has gone up, and the coupon's only 7%, and people will pay less than $1,000 so that there's some capital gains component to this bond, and then when you add that capital gains to the 7% coupon, you get a total of 8%. There's some other terms to note here. For instance, a debenture. What is a debenture? A debenture is a bond that does not have any collateral. right? There's no collateral. Um, so it's an unsecured bond. Its bond basically promises to pay interest from the income the company generates, but there's no assets that make collateral. Um, there sometimes, especially in the case of railroad companies, they might put something like a whole train as collateral for a bond issue, or a hospital may put up a new building as collateral for a bond issue. Schools often do that, um, and local governments, right? So they have bond issues to build a school, and that school becomes put up as a collateral for that bond. And so, but a debenture is unsecured without any particular collateral. You may find some other similar sounding um, terms in the book. For instance, indenture. An indenture, and is actually, indentures are the contract. They're the contractual clauses within a bond. So if the company is issuing a bond, it may say, well, we promise to set aside so much of liquid assets, or to maintain liquidity, we'll have so much cash in hand at all times, or inventory at all times. And those are contractual clauses that kind of guarantee some safety of the bond. And a very common one is a fund to repay the bonds when, so it's called a sinking fund. A sinking fund would be a fund in which the company puts aside some money to buy back the bonds every year, so that in the end it doesn't have a $10 million liability, or 10 million is not too much for any company, but a large liability at all at one time, right? So those are the contractual clauses called indentures that form a document called an indenture, indenture, different from debentures, right? Debentures are just a term that refer to unsecured bond. And of course, don't confuse all of that with dentures, which your grandma might be wearing. Anyway, so let's get back to analyzing this bond. So what is the bond's price currently? A bond sells for par, so its price is $1,000 right now. Its yield to maturity, if a bond sells for par, we know that yield to maturity is equal to its coupon rate, right? There's no capital gains. It's only the coupon that you get, and that's the total return on this bond. That's the yield to maturity. But now we're told that the bond's risk assessment is raised. Once again, remember, it was because a non-UT Tyler graduate is about to become the CEO. So then the investors require a higher yield from this bond. To invest in this bond, they require a yield of 8%. 7% is not good enough. Of course, 8% is nominal, 4% on a semi-annual basis. The coupon value, once a bond is issued, the coupon, which is 7%, or $70 per year, which will be, or by default, we'll assume it's a semi-annual payout, so $70 per year is $35 every 6 months, right? That does not change. Once the bond is issued, the par value does not change, right? It's going to be 1,000. So what does change is the yield and the price at which the bond sells in the market, right? So let's see. The new price, well, we know how to calculate a price now, but the coupon is $35, which is half of $70, $70 being 7% of par, 1,000. It's a 10-year bond, so there's 20 semi-annual payments, and the yield is now 8%, which is 4% in the semi-annual basis. So we already use the calculator. This would be simplified. Here you're using the formula. You get the answer, and using the calculator to second FV to clear. 1,000 is future value, 35 is payment, 10 is N, 4 is I by Y, and we say compute PV, and we get, let's see, I think I put 10 for N, it should be 20, it's 10 years or 20 semi-annual payments, so 20 is N, compute PV, and we get the answer 932.05, right? So that's the same as what we have on screen. So that's the current price, and you note that this price is less than $1,000, right? Because coupons are only 7%, and we need to create some capital gains so that the total return from this bond is going to be 8%, which is what is required now from this bond. Okay, so moving forward. Now, if Gotcha's management makes the wise decision of hiring a UT Tyler graduate for the open CEO position, and analysts respond by raising its bond ratings, thereby lowering the required yield to maturity to 6%, what will be Gotcha's bond's intrinsic value, right? So, well, things have changed, and now the yield to maturity doesn't need to be 8%, not even 7% we started with, but only 6%, right? Then what is the bond's price? And here you'll see that the term used is bond's intrinsic value. What we are calculating is what the bond's price should be. And so it's intrinsic value. And if markets are working efficiently, then that will be the price of the bond as well in the marketplace, right? So another term to be familiar with. Okay, after looking at all the answers, what are some conclusions we can draw? Right, let's calculate the bond's value if the only thing that changed is the YTM, right? So let's say that's 3% semi-annual, 6% annual. So in the formulas, instead of 4, we are using 3. Of course, in the calculator, we'll change the I to 3% and recompute present value, and we will get 1,074.39. So we've done enough of these that I'm not going to take you to the calculator and show you this calculation. You can do it, confirm that yourself. So if the yield to maturity falls to 6%, then it's 1,074.39. The price is actually higher than the par value, and that happens too. Right? So what can we conclude? Well, there's some things that we can look for. If the coupon rate and the yield to maturity are the same, then the bond's price equals the par value. And of course, we can say it the other way around too. If the price equals par value, then we know that the yield is the same as the coupon rate. If the coupon rate is less than yield, right? So when our yield went up from 7 to 8%, coupon rate is always going to stay the same, 7%, right? Then we saw that the bond's price fell below the par value. Once again, par value stays the same. It's only the price that changes with changes in yield. Then the last scenario, we saw that when the yield fell to 6%, coupon rate remained at 7. So coupon rate exceeded the yield to maturity, then the price of the bond was higher than the par value, right? So if you remember these things, that'll give us some direction, and we could easily be able to tell if we made a mistake, if our answer is not in the right direction. Suppose we have a situation where coupon is less than yield, but when our calculated price comes out to be greater than par, we know that's got to be wrong. Okay, and of course, what we see is that the bond's price changes, right? It's sensitive to bond yields, and bond yields typically are also based on the current level of interest rate. Aside from risk assessment we were talking about earlier, interest rates also have an impact on bond yields. So, and for this particular bond, it had 7% coupon. So at 7%, if the yield was 7%, then the price of the bond would be $1,000. When the yield was 6%, the price of the bond was higher than 1,000, which we just calculated. When the yield was 8%, the price of the bond was less than 1,000, and of course that trend will continue, and you'll see that this is slightly, it's not exactly a straight line, it's a curve. It's a curve, and we basically have this relationship between bond price and the yield to maturity, and it's called the price yield curve. And this is the price yield curve for the bond we were just talking about. Where we had calculated the bond's price at 7%. We knew we didn't have to calculate. We knew it would be 1,000. We calculated its price at 8. We calculated its price at 6. If you calculate its price at 5% or 4%, then you'll have more points to plot this curve out. But the bond's price is sensitive to yields. As yields fall, bond prices rise. As yields rise, bond prices fall. Okay, so what goes into yield computation for a bond, right? Let's look at this. The Bondo Corp wants to issue 10-year bonds. Its bonds are rated AA, and the company's bonds carry a liquidity premium of 0.95%. Bond markets currently assess a maturity risk premium of 0.1 times T minus 1%, right? So it's a formula, and T will be the maturity of the bond, how long the bond has till it matures. This time it's a 10-year bond, so we'll be putting 10 over here to calculate the maturity risk premium of the bond. The real risk-free rate is 2.5%, and the inflation is expected to be 3% for the next 4 years, and 5% thereafter. The following table lists the various investment-grade bond ratings and their default risk premiums. Right, so here's the default risk premium with bond rates. We only have what's known as investment-grade bond ratings. Anything below a BBB, this is a Standard & Poor's rating system. Anything below a BBB is called speculative grade or junk bonds, right? And people who want to speculate look at those bonds. But BBB and above are called investment grade bonds, and so they have varying levels of risk of default, and as we go down the risk is higher, so the risk premium gets higher, right? Now this Bondo Corporation bond's AA rated, right? So we'll be assigning a default risk premium of 0.7%. And as you can see, we have various risk premiums. First, any yield or any interest rate has got to be based on what's known as the real risk-free rate, right? And what is the real risk-free rate? It's really the opportunity cost of lending your money. You don't have your money with you, and if you need it for some reason, you're going to be out of it. It's the opportunity cost of money. So if you lend your money, you should be seeking compensation for the opportunity cost at least, right? And that's 2.5% per year. But you also need to be compensated for inflation. So there's going to be an inflation premium added to it. And and we'll need to calculate a 10-year inflation premium. It's just going to be the expected inflation of averaged over 10 years. So the nominal risk-free rate is the real risk-free rate plus inflation premium. So if someone just says risk-free rate, they're actually talking about nominal risk-free rate, right? And that will be, of course, the basis, the foundation of any yield. And then on top of that, we have the various risk premiums. So the company has default risk premium, it has a liquidity risk premium, right? 10-year bonds themselves will have a maturity risk premium because you have to wait 10 years before you get your money back, right? Anyways, so all of those will go into calculation of the yield to maturity on Bondo Corp bonds. Let's see. So the bond's yield depends on market factors as the real risk-free rate, inflation premium, and maturity risk premium. And so these would apply to all bonds. So 10-year bonds will have maturity risk premium that applies to 10-year bonds. 5-year bonds will have a specific maturity risk premium that apply to 5-year bonds. Right? Inflation premium will be based on the average level of inflation that we expect to see over the next 5 years. So for a 5-year bond or 10 years for a 10-year bond. Liquidity premium and default risk premium are firm specific or company specific, right? Depends on how well the company's bonds sell in the marketplace. What's the demand for the company's bonds? High demand would mean low liquidity premiums, right? And of course, default risk premium is based on how much or how likely it is that the companies will get into financial trouble and default on its payments. And this is the part that's based on the bond ratings, right? All right, so we got this real risk-free rate that's given to us. We can calculate the inflation premium because we were told that the first 4 years inflation was likely to be 3%, and for the next 6 years it's expected to be 5%. So if we average that out, 4 times 3, that's 12, plus 6 times 5, that's 30. Add 12 plus 30 is 42. We divide that by 10, we're getting an average of 4.2% per year over the next 10 years. And this is just a crude average. We're just taking an arithmetic average. In reality, we should be using a geometric average, but we'll ignore that in our context right now. At the moment, we don't need to worry about that. We are looking at an average, some kind of average of inflation, and that will give us an inflation premium. Then the maturity risk premium, we were given a formula for that. It was 0.1 times t minus 1%. T is 10 here, so 10 minus 1 is 9, times 0.1 gives us 0.9%. That's the maturity risk premium. The liquidity premium for this company's bonds given to us at 0.95%, and the default risk premium came from that table, knowing that the company's bonds were AA rated. The default risk premium for AA rated bond is 0.7%. All right, so for this company, the Bondo company's bonds, the 10-year bonds, will carry a yield of, the notation is R of D. Basically, it says return on debt. But it's a return to the investor. It's actually a cost to the company, isn't it? Anyways, that R star is the real risk-free rate, and IP is inflation premium. Then MRP is maturity risk premium, LP is liquidity premium, and DRP is default risk premium. All of those will add up to give us a 9.25% yield to maturity on Bondo Corp bonds, 10-year bonds actually, because we used a 10-year inflation premium and then we used a 10-year maturity risk premium, right? Treasury bonds are considered to be default risk-free. So this DRP will not apply to Treasury bonds. Right? Further, Treasury bond markets are highly liquid, hence a 10-year Treasury bond will not carry a liquidity premium. So that liquidity premium for Treasury bonds is almost insignificant, 0. So for 10-year Treasury bond, that was the second part of the question, was for a 10-year Treasury bond, the returns or the yield should simply be the real risk-free rate plus the inflation premium plus the maturity risk premium. There's no liquidity premium or default risk premium to worry about. We add those three values and we get 7.6%, right? It's 2.5 plus 4.2 plus 0.9, 7.6%. And just we should remember that when someone says risk-free rate, and doesn't mention real risk-free rate, they're just actually talking about the nominal risk-free rate. So R of RF, or the risk-free rate, is simply the nominal risk-free rate, which is the real risk-free rate plus inflation premium. And in this case, it would be 6.7%. Okay, let's talk about interest rate sensitivity of bonds, right? We know that bond prices are sensitive to interest rates. We saw that if yields fall, bond prices rise. Well, interest rates, we just saw, is a critical component of yield, right? If yields rise, bond prices fall. If yields fall, bond prices rise. So bonds are sensitive to interest rates, but there are also different things that contribute to the sensitivity of a bond's value to interest rates. First, it depends on the coupon rate. If the coupon rate is high, then a bond's price is not as sensitive or less sensitive to interest rate changes. And, of course, the maturity of the bond. If the bond has long maturity, then it's more sensitive. And that's what we're going to be looking at here. So Shiny West Incorporated has issued 3-year bonds as well as 10-year bonds. Both bonds carry a coupon of 8%. You would like to invest in Shiny West, but you must decide which of these bonds to buy. Consider the implications of these alternative investments in Shiny West with regard to reinvestment rate and interest rate risk, right? So we don't have any data for calculation, but we do have a qualitative question to ponder. So all bond prices are inversely related to interest rate fluctuations. Long-term bonds happen to be more sensitive to interest rate changes due to greater magnitude of discounting and very distant payments. Right? With long-term bonds, the par value comes in much farther in the future, and so you're using the yields to discount those, right? There's a lot of coupon payments also that come in the future towards the end, and you're using the yield to discount those. And if the yield changes, then it'll have a major impact on those distant payments. Right. So we're looking at the fact that the price of the bond will change a lot more if we're talking about a 10-year bond, and if interest rates will go up by 1% or go down by 1%, the 10-year bond's price will change a lot more than the 3-year bond. So the price risk of a 10-year bond is larger, right? But there's another side to it. If interest rates change, if interest rates rise, right, with the 3-year bond, you're going to be able to get back your par value in 3 years rather than 10 years, and take that 1,000 and reinvest in a higher interest paying bond, right? With 10-year bonds, and that won't be possible. Of course, you can always sell your bond, but you're going to be selling it at a lower price. Remember, if interest rates rise, then your bond values will fall. So you won't get 1,000. You're going to be selling it at a lower price, and so you won't have 1,000 to reinvest at a higher rate, right? So by locking in uh, a 8% coupon for 10 years, you basically are giving up the opportunity to, say, invest in a 10% bond, um, earlier than 10 years from now. So that is called the reinvestment rate risk. And that reinvestment rate risk is basically higher for 3-year bond because with a 3-year bond, you will have to reinvest after 3 years. We were talking about interest rates rising, but what if interest rates fall? Well, if interest rates fall, then in 3 years, you'll get $1,000 to reinvest in a lower interest rate bond. So that reinvestment rate risk is higher for that 3-year bond. So what should you do? If you expect interest rates to rise, then invest in a 3-year issue, right? Because bond prices will fall, 3-year bond price will fall less. So even if you sold the bond, you'd be better off. Or if you waited for 3 years, you'll get the par value back, and you're going to be, which is $1,000 rather than whatever the current price of the bond is, right? So if interest rates are rising, invest in 3-year issue. You get the $1,000 after 3 years. You can invest it in a higher coupon bond. But if interest rates are expected to fall, well, then the 10-year issue is better because you're locked into getting 8% coupon for 10 years. And here's the price yield curve of the two bonds, because this is simply looking at interest rates and the price of the bond. And you'll see that the 10-year bonds price changes a lot more. At 8%, both bonds are priced at 1,000. Why? Because both bonds have the same coupon rate of 8%. But as yields fall, as interest rates fall and yields fall, then the 3-year bonds price will rise less than the 10-year bonds price. When interest rates rise, the 3-year bonds price will fall less than the 10-year bond. In other words, the 10-year bond is more sensitive to interest rate changes. And also remember, as I told you, that other factors also impact interest rate sensitivity of bond prices. One big thing is coupon rates. Higher coupon, lower sensitivity of bond price to interest rate payments, and vice versa. Okay, here we're just going to look at the breakdown of a bond's yield into its two components, capital gains and current yield. And the reason it's important is because they're taxed differently. Capital gains usually are taxed at a lower rate than those coupon interest payments on a bond, because that's considered current income. So Mr. Filthy Rich decides to invest in Yo Mama company bonds, which carry a coupon of 3% and are due to expire in 3 years. The bonds are currently selling for $910. Mr. Filthy Rich faces a lower tax rate for capital gains than for ordinary income. As an investment advisor, you're asked to break down the total return from Yo Mama's bonds into current yield and capital gains yield. Then discuss its implications with Mr. Filthy Rich. Right? So let's compute the total return of this bond. It's priced at $910. It has a 3% coupon, 3% of course of par, 3% of $1,000 would be $30, and annually, semi-annually, it's $15, so 30 by 2. And we have to calculate the yield. So, of course, at maturity, it pays $1,000. It's a 3-year bond, so there's six semi-annual periods. And of course, this kind of calculation we simply don't want to do by hand because it could take us forever. So we need a calculator, which is second FV. Here it's going to be 1,000 is the future value, 15 is payment, $910. This is the price, so we'll pay it, make it negative, present value. Then 6 is N, right? And then we need to compute I. And the answer is 3.17%. Now that is semi-annual, right? So that's a semi-annual yield to maturity. At 3.17% using our fancy schmancy handy dandy calculator. That's a semi-annual yield. Multiply it with 2 and you get the annual yield of 6.34%, right? So the total gains from this bond, the total return on the bond is 6.34% per year. This total comes from two sources, the current yield, and which is the current income component, and the capital gains yield. Of course, the two are taxed differently. So the yield to maturity is a sum total of current yield and capital gains yield, right? When you learn how to calculate the current yield, that's easy. It's 30. It's the annual coupon divided by the current price of the bond. Current yield is 3.3%, right? We just found out the yield to maturity, which was 6.34%. So capital gains yield is that yield to maturity minus the current yield. And we do 6.34 minus 3.3, we get 3.04%. So capital gains yield is 3.04%, right? Note that more than half of the returns from this investment comes from its current yield. Out of, more than half of the 6.34% total return is coming from current yield. And current yield is typically taxed at a higher rate, especially for people like Mr. Filthy Rich who will be in high tax brackets, right? So since we know that Mr. Filthy Rich faces a lower tax rate on capital gains, this is probably not the best investment for him. Our advice would be to seek out another bond in which the current yield component is a lot lower and the capital gains yield component is much higher. And that would be more tax efficient investment for Mr. Filthy Rich. And with that, we're going to end this presentation. Definitely go through your chapter. There are some things in there, especially terminology we don't talk about in these lectures, which are focused mostly on solving problems. And I will be back with the lecture on the next topics.